We will now take our first question from Sarah McFarlane from the Wall Street Journal. Please go ahead.
Hi, Ben and Jessica. My first question is just around gearing. I was wondering whether your gearing target was still 15 to 25%, given the $65 billion debt target doesn't get you there. And if it has changed, why has it changed? And secondly, I was wondering if you could just clarify the shareholder payout plans. Is it 4% a year, every year in the third quarter from now on, and then perhaps buybacks once you reach $65 billion debt? Or can you give any kind of additional information on the payout plans?
Thank you, Sarah. And let me start with the second question. Jessica will talk about the first one. So first of all, it is indeed 4% with immediate effect. And we said every year we will now see regular increases in dividend. That's, of course, subject to board approval. We haven't announced when that will be. So therefore, you will have to wait until the next quarter. But it will be an increase every year. Jessica, on the gearing and the rest of the payout plan?
Great. Sarah, thank you for your question. Let me start by saying, in substance, nothing has changed. We remain committed to AA metrics through the cycle. What we changed was the reference point. And so we moved from gearing to net debt and set a threshold target of $65 billion. The gearing ratio was proving to be a bit messy, frankly, to deal with, because there are a lot of accounting implications that go into the numerator and the denominator. The impairments in the second quarter had an impact as well. And so it was becoming a less useful way of signaling to the market how we can demonstrate our movement towards the AA metrics. So the $65 billion in net debt, we feel, is a simpler metric, an easier metric to keep track of. But in substance, it's no different. It's how we're going to demonstrate that we're moving back into the AA range.
Okay. Thanks, Jessica. Thanks very much, Sarah. Can I have the next question, please, operator?
We will now take our question from Laura Hurst from Bloomberg. Please go ahead.
Hi, good morning, Jessica, Ben. My first question is about the new dividend policy. So why have you decided to go down this route? Are you not potentially putting yourself into a corner later down the line by sort of recommitting to the progressive dividend? And my second question is, can you offer us a bit of a roadmap of how and when you'll get to the $65 billion threshold for net debt? You wiped off $4 billion this quarter. If you replicate that, we could be at buybacks in just 2-3 quarters' time.
Okay, thanks very much, Laura. I think there was a little bit of a sound issue there, but I think I got the questions to be when we reach the 65, and secondly, whether we could put ourselves in a corner by increasing the dividend right now. So, Jessica, would you like to take them?
Absolutely. So thank you, Laura. In terms of the $65 billion, what I would encourage people to do is to look at the cash generation that we have delivered in the third quarter of some $9 billion, excluding working capital. And this is what, at a moment in the cycle that we think is a low moment, so kind of at the down portion of the cycle. And that is, I think, a better way of considering what is the cash generation the company can deliver at this low point, and to look forward from that to get a sense of the trajectory in terms of free cash flow delivery and ultimate net debt reduction. What you saw in the third quarter, again, in this low point in the cycle, was that we reduced net debt by some $4 billion to 73.5. So I think that's a good indication. If I were to try and provide some other moment in time, I would have to provide a whole suite of assumptions around the macro, the price, the margin environment, the volume environment. And given the level of uncertainty that we continue to see, I think it's better for us to look at what we're currently generating as a signal in terms of the trajectory going forward. In terms of the progressive dividend and the 4%, when we did the dividend reduction in the first quarter, we talked about how we'd rebase the dividend. So we're coming from a very different point in time, starting from $5 billion. The 4% for us is very affordable, and it's sustainably affordable, which is, I think, an important part of the investment case. We've also talked about increasing shareholder distributions in the future once we get past the $65 billion, the 20 to 30% of cash flow from operations. An important piece of that will be share buybacks. So it is on our mind that we need to match dividend growth with share buybacks over time to ensure the total shareholder distributions remains affordable and sustainable through time.
Thanks, Jessica. And before we take the next question, let me also say that for those of you who perhaps had difficulty seeing the resolution of the slides in the video itself will be posted on our website and the slides separately as well. So that hopefully will give you a higher quality view of the key messages and the numbers that we gave to you today. But Cecilia, could we have the next question, please?
We will now take our next question from Ron Busso from Reuters. Please go ahead.
Hi, good morning, Ben and Jessica. I hope you're doing well. Two questions as well. First one is, I was wondering if you could provide some idea on your targets for growth in renewables. Any idea of scale that you're already kind of thinking about? And my second question is about Prelude, which just turned out to be a bit of a disaster. What's happening there? It's still down. When will it come back? And more broadly, what kind of lessons are you learning from this? I mean, it's a huge project that's been written down twice now. What does it mean for LNG projects going forward as well? Thank you.
Thank you very much, Ron, for your questions. And yes, we are doing well. Hope you are well too. Let me take the two questions and then Jessica can say something about the impairment. So I think our plans for renewables, as you call it, I think the details of that you probably have to wait until February, Ron. But let me already say that if you look at the hydrogen, bio, power businesses that are all part of that marketing platform from which we want to then build these businesses, that part of our business will be attracting about 25% of our capital. That is actually almost more than a doubling, as a matter of fact, because in aggregate, we tended to spend about 11% on that part of the business in the last 3 years. Now, how that is broken out, wait for February when we give you a whole lot more insight exactly how we plan to do that. On Prelude, Prelude indeed is a difficult moment for us at this point in time. Of course, it had some difficulties with the original startup, as has been advertised earlier in the year, but that has been compounded by the pandemic as well. As you can imagine, in Australia, we have some limitations with what it is that we can do, getting people on and off board. Some of the initial teething troubles are therefore a little bit more difficult to solve, particularly if you have to bring in people from overseas, bring in parts from overseas. And we have been really, really very clear, not just for Prelude, but for all our assets, we need to bring these assets up in a safe and responsible way. So yes, indeed, it is disappointing. I wish we could say that Prelude was running nicely at this point in time. It will take a little bit longer. It will probably take until the end of the year. Indeed, there is another impairment charge, but Jessica, can you say a few things about the impairments, please?
Yes, so in the third quarter, we did recognize an additional impairment for Prelude that related to some of the issues that we've seen during the year, that in the third quarter we weren't able to fully resolve for some of the reasons that Ben just mentioned. And so playing that out for the next couple of quarters, that has an impact obviously on our cash flow and our earnings and therefore the value of the asset. In addition, there was a new view on some of the infill wells that came through in the third quarter that also contributed to the impairment. I'll say though, we expect to get the asset running. It will generate LNG for us. That will be an important part of our portfolio. And we're looking forward to getting that asset safely up and running and contributing to the portfolio over the next decades to come.
Thanks, Jessica. Thanks very much, Ron. Cecilia, can I have the next question, please?
Anjali Ravil from Financial Times. Please go ahead.
Hi, Ben. Hi, Jessica. Ben, you've spoken a bit about Shell's exceptionalism, but my question for you is, going by the stock price, why don't investors see this as well? I mean, do you think that they will see the light and reward Shell at some point? And in which case, when do you think that will be? And my second question is around any successor to Chad as chairman. What qualities are you looking for in any new chairman?
Thank you very much, Anjali. it's of course not my place to comment on or determine the share price for that matter. But let me say a few things about it. I do understand the pressures that our sector is under. We are, of course, suffering a triple whammy. First of all, we were already a little bit in the doghouse, if I can use that term, because of the capital discipline, or rather indiscipline, that the sector has had in the first part of this century. Of course, COVID has given us unmatched difficulties in the immediacy. And then, of course, there is the backdrop of the energy transition, which puts question marks as to what is the future of this sector all about. I do think we have clear responses to all three of these, though. First of all, we are so much more disciplined, and I hope that will be acknowledged, and has been acknowledged actually over the last few years. The way we brought costs down, but also the way we invest with discipline. I think people will now see that in the 6 months during COVID conditions, we actually have a remarkably well-performing business, which gives a lot of confidence for the future. And thirdly, our strategy that we are displaying now is one that is very much also relying on the energy transition to bring future value. We have to get that message across with enough conviction and detail for people to move away perhaps from the old way of valuing our stock as basically a future of dividend streams that needs to be discounted to a net present value. Instead, we have to show that we have promise of growth into the future, but also growth right now. Now, as to the chair succession, I think it is well known that our current chairman, Chad Holliday, will step down by our next AGM. That is just part of the way the UK Governance Code work, and we have made that very clear. The process of finding the new chair is started, and our senior independent director is also engaging with shareholders to talk about what the characteristics of the board composition and also the chairman needs to be going forward. Thank you very much, Anjali. Can I have the next question, please, Cecilia?
We will take our next question from Bert van Dijk from Deutsche Financial Daily. Please go ahead.
Yeah, good morning, Ben and Jessica. I've got a question about the timing of the announcement of the growth in the dividend again. Seems rather fast after you cut the dividend in earlier this year. So I was wondering, has this moment of regrowth been brought forward because you got more confident in the outlook for demand in the market, or was it the original plan to regrow it so fast again? And my second question is about the shale business of Shell. There's a lot of M&A going on right now in the shale business in the US. I'm just wondering whether you see for Shell a role going forward in this consolidation taking place right now, or that you will keep the business as it is, or well, maybe you can reflect on the future of your shale business. Thank you.
Yeah, thanks very much, Bert. Well, the dividend increase, it very much was something we wanted to do. And as I said to the previous question, we believe our investment case needs to be one that is founded on resilience, is very much a growth story into the future, but also a growth story right now. Now, when we cut the dividend 6 months ago, that was a very painful moment, but also a moment where we thought prudence was important. And alongside resetting the dividend, of course, we took some very significant other measures to preserve the financial resilience. And we still believe that that was the right thing to do. But right now, I think we know more about how we perform. We have seen how successful we have been in stabilizing the financial outlook for this company, debt coming down. So I believe we are now at a place that, again, with prudence, we can start increasing our dividend again. We said very clearly we want to have a progressive dividend. And if you want to have a progressive dividend, it means growing it. And the 4% growth was considered by the board the right percentage to launch. On shales, yes, I see what's going on. We are very clear with our portfolio where we want to go. You've heard it in the presentation. We are very clear with the capital frame that we have 90 to 22 billion. Within that, we may be able to do indeed some small inorganics, but we believe that large organic moves are not affordable for our financial framework at this point in time. Thanks very much, Bert. Cecilia, can I have the next question, please?
Emily Godson from The Times, your line is open. Please go ahead.
Morning, thank you very much. Just to pick up on your answer to Ron's question. So you were saying 25% of CapEx going to low carbon and hydrogen and things. So is that from next year? You're saying basically $5 billion a year from next year on that? On the net debt and the kind of run rate to reduce to 65 billion, if I follow what Jessica was saying, you're saying you reduced by 4 billion this quarter. So are we right to read from that if things continue in the same macro circumstances, you could potentially be starting buybacks by sort of middle of next year? And so just finally on Prelude, can you just clarify what the total impairment on Prelude has been to date? I don't think you said at Q2 how much of the 8 to 9 billion then was on Prelude versus on other projects. So what's the total impairment? Thank you.
Yeah, thanks very much, Emily. Let me take the first one, and the other 2A and 2B will be for Jessica. First of all, around 25% that I mentioned of the $19 to $22 billion of CapEx that we have earmarked as a sort of foundational level of spend, that is actually more or less from today. But I want to be very clear, that is marketing, hydrogen, power, and biofuels, and maybe a few other bits and pieces in there. And we see that number to be pretty stable for the next few years to come. Maybe if we get to a phase that we are going to be able to increase our spend after we have reached the $65 billion and after we have increased shareholder distributions, that percentage may change, but it is more likely to move up than it is likely to move down. I think it's probably fair to say that for next year, we will be spending indeed, out of that sort of $19 to $22 billion, about $5 billion on our growth businesses. So roughly in line with what I said. Jessica, can you take the other two questions, please?
Yes, I can. And maybe just one other comment on the amount of resources we're putting into our growth businesses. I'd also highlight that we're also investing significant amounts in our operational expense as well. That's another way we grow these businesses. And of course in R&D in places like hydrogen. So you need to look in other parts of our financial statements to also get a sense of the total amount that we're investing in these growth businesses. In terms of the impairment for Prelude this year, it's about this quarter, it's about $1 billion. In terms of what it is to date, Emily, let's get back to you. I don't have the number off the top of my head between the pre and the post-tax numbers for Q2, and I don't want to give you the wrong number off the top of my head, so we'll get back to you.
Okay, thanks very much. Cecilia, can we have the next question, please?
Robert Perkins from Platts, your line is open. Please go ahead.
Yeah, hi, thank you both. So a couple of questions. First of all, on the plans to focus the upstream divisions on the 9 core areas, can you just talk about what the implications are in terms of asset sales for that part of the business, and whether you can commit to increasing production? I mean, I know you don't have hard targets for these things, but can we assume that production will increase until a certain point in the near future and then decline? Any color on that would be great. And then on CapEx, a couple of things. You have guided towards 20 billion or less this year. I note that your 9-month figure look like it's going to be undershooting that 12.5, so a gap of about 7 to 8 this year. Am I missing something? Is there going to be a big chunk in the current quarter, or are you going to come in quite a bit under your 20 billion figure? And then on the low carbon, appreciate the detail around the percentage of CapEx going forward. This year, though, can you give us a figure? You had said around, you'd mentioned the 11%, and in previous years, a figure of 1 to 2 billion a year. So are we on around 2 billion for low carbon spend this year? Thank you.
Okay, thanks very much. Let me take the first question, and then perhaps the and also the last one, and maybe Jessica can talk about where we are headed with our CapEx number. The last question, Robert, let me just clarify. The 25% of the CapEx that we sort of talk about today, had the 19 to 22 billion, is not just power. Yeah, it is what we consider to be the future of energy businesses. So it indeed includes marketing as well, because we see marketing as an important platform business for the future of energy. It does include power. It does include hydrogen. It does include biofuels. So, and that total has gone from roughly 11% to now roughly 25% going forward. On the upstream part, indeed, we are concentrating our portfolio, or rather high-grading it. About 80% of our cash flow from operations comes from these 9 core assets that we defined. And we intend to spend at least 80%, if not more, of our CapEx on these 9 assets as well. So the other assets, and we have around 30 positions or so in upstream, they will be, as I said, managed in that lean portfolio mode. And think of it basically as 3 categories, if you like. In there will be, say, the Surinams of this world, where we will have to see whether that turns into a viable business that can then at some point in time become part of the core. In there will also be businesses that we see are very good business at this point in time. We just want to run them for cash, and we don't want to have too much additional burden on them. And then there will be businesses in there that we believe we will have to divest. And it can well be, of course, that what is currently in the core will end up in the lean model as well. It very much depends on how these businesses go in terms of running room, what we see in terms of future value potential, how we see the risks maybe of these businesses going forward as well. So it is not a classification that is forever. Do we believe that we can grow our business? Well, in terms of cash, we have always said it is value over volume. We do not have volume targets, but it is probably fair to say that 2019 was the high point when it comes to our oil production. Jessica?
Great. Let me start with the CapEx question for this year. Indeed, you're right that the run rate for CapEx in 2020 would indicate that we're likely to come in below $20 billion for the year. So I think that's a reasonable expectation. There's a couple things to say. The fourth quarter, we typically do see CapEx tick up as we try and complete projects towards the end of the year. So that's a normal trend that you see. So I would expect it to be higher than it was in the third quarter. Another important piece is that there are inorganic transactions that we are working. Those are binary. They may come this year. They may happen next year. And that's why there's always a little bit of a flex with respect to where we're going to land CapEx even as we go into the fourth quarter. There's another question about the composition of the CapEx this year and how much of it's going towards growth. As Ben mentioned, you have to look at not just the power spend, but also the spend in biofuels and in hydrogen that we're making. And as I indicated before, if you just look at the CapEx, I think you could be underplaying the total amount of investment that's happening. We also have important milestones we've reached on some CCS projects this year. NBS has been an important part of our strategy and story in 2020. That's also an important OPEX number for us. So again, in terms of the total spend on low carbon, no carbon areas of our business, it's really spanning R&D, OPEX, as well as CapEx. Strategy Day in February will bring more detail in terms of what you can expect on the CapEx side, as well as the total resource allocation across the suite of growth opportunities for us.
Great. Thanks very much, Jessica. Cecilia, next question.
From Mark Lamy from Energy Voice, please go ahead.
Good morning, thank you. You'll know there have been a number of instances in the UK North Sea in the last month with COVID outbreaks and suspected cases. We're aware that Shell's going to try to start to test workers before they head offshore, so pre-mobilization testing. The question is, are you satisfied with how Shell has handled what is obviously a very difficult situation, and what have you learned from this situation?
Thank you very much, Mark. We have learned an awful lot, and some things, of course, were humbling learnings and many of them also quite encouraging learnings. It is fair to say that that COVID also has visited us in a negative sense. So year to date, 12 people who work for Shell or work with Shell contractors unfortunately have perished. And of course our thoughts are with their families. These are all 12, of course, individual tragedies. At the same time, though, I'm also happy to note that we have managed to keep all our assets up and running. All our major distribution assets are working. The very, very, very vast majority of our retail outlets are up as well. So we have been able to do remarkably well thanks to our remarkably resilient staff that have managed this crisis incredibly well. And the UK and the North Sea is no exception. Did we have infections amongst our own staff? Yes, of course, and that has happened, unfortunately, a number of occasions, but we have not had mass outbreaks. We have not been in a position that we had to really completely rethink how we are running our preparedness for our operations. Indeed, in the UK, we are now going to a solution where we do pre-departure testing. We do that with a private lab. I think it's all in line with what the industry is aiming to do as well. And so far, I think we can be, touch wood, we can be pleased with how well we have been able to contain the situation. Thanks, Mark. Can I have the next question, please, Cecilia?
We will take our next question from Javier Blas from Bloomberg. Please go ahead.
Thank you so much for taking a second question for us. Much appreciated. Two questions, if I may. Ben, the first one related to demand. You have, if I remember the number correctly, about 40,000 petrol stations worldwide, and beyond selling the coffee and so on. I would like to ask you what those petrol stations are telling you about global oil demand right now. Is it still growing? Is it weakening because some parts of Europe are going again into lockdown? What is the global picture that you see as now? And my second one on production, as you indicated that 2019 probably was the high point for Shell production. Can you give us a bit more color? Where do you see Shell production going on forward? Where do you see the production, say, in 10, 15 years' time? Thank you.
Thank you, Javier, and I think this will also be the last question. I think, let me start with the second one. It's very clear we do not have volumetric targets or outlooks. We abandoned that a long time ago. Our focus is on value. So we never talked about look at our volume growth, and we will also not say look at our volume decline. These things are an outcome of a strategy that is focused on maximizing value. We believe that our upstream business has longevity well into the next decade, if not beyond. And that will be longevity where we optimize the delivery of value. We will probably have to ask you to be patient and see what happens to our volumes rather than make a prediction on it. But what I can tell you is that upstream will be an essential part of our portfolio long into the future. On the marketing part of our business, yes, indeed, we have something about 40,000 retail stations. We have 30 million customers. We have a million B2B customers every day, and are all telling us what is happening. We see what sort of stories we have coming from the different markets, and it is actually quite a diverse story. So some markets are ahead. Just this morning, I had an exchange with our country chair in China. He says we are well ahead of our plan for the entire year in China. And China is not the exception. In general, we have seen that our retail business is 25% ahead year to date compared with last year. And our lubricants business is 40% ahead in this quarter compared to last year. So indeed, a very strong performance, which is not just volumetric. Again, also here, it is value rather than volume. We have seen indeed a better margin performance. We see our customers taking more V-Power. We see our customers increasing the size of their basket with about 15%. And altogether, therefore, we see a much stronger performance in our marketing business going forward. And we think that is performance that is with us to stay. Now, that brings me to the end of the Q&A. And therefore, I would like to say thank you all very much for, well, first of all, your questions, but also for joining the call today. I hope that the call has brought you more clarity on the strategic direction, but also on our financial framework. And I also hope that it has given you a real taste of how well we are positioned. We are ready to capture the opportunities and the value that is there in the energy transition. And I also hope that it has given you some hunger to know a little bit more about our strategy, because it is a strategy that will deliver. And therefore, there is more to come in our strategy day on the 11th of February next year. Thank you very much again. Have a great rest of the week, and please stay safe, everyone.